Most of the Republican tax plan will kick in beginning in January, but taxpayers will not see every change immediately. To see how the plan will affect your taxes, try our calculator. Before January 2018, some taxpayers can make changes before the end of 2017 to put themselves in a better position for next year. January 2018, a majority of provisions will go into effect. February 2018, this is the earliest that most will see changes in their paychecks. April 2018, only a few changes will apply when people file their 2017 taxes. January 2019, the individual mandate penalty and alimony deductions disappear. April 2019, taxpayers will see most of the changes when they file 2018 taxes. January 2026, unless Congress extends them, nearly all tax changes for households will expire after 2025. Before January 2018, some taxpayers can make changes before the end of 2017 to put themselves in a better position for next year. January 2018, a majority of provisions will go into effect. February 2018, this is the earliest that most will see changes in their paychecks. April 2018, only a few changes will apply when people file their 2017 taxes. January 2019, the individual mandate penalty and alimony deductions disappear. April 2019, taxpayers will see most of the differences when they file their 2018 taxes. January 2026, unless Congress extends them, nearly all tax changes for households will expire after 2025. Savvy taxpayers who want to see changes in their paychecks immediately. The IRS is working to update its withholding table so that payroll managers know how much in income taxes to hold back from employees. The agency said that changes would not be reflected in paychecks until February at the earliest, but those who want to see immediate effects can calculate their own withholdings for their employers. People who give a lot to charity. For those who itemize their deductions, charitable donations made this year will result in a greater tax benefit than giving in 2018. Homeowners who pay a lot of property taxes. Taxpayers may be able to prepay their state and local property taxes, depending on where they live, in order to avoid the $10,000 deduction cap going into effect next year. Taxpayers with freelance income who make quarterly income tax payments could also make an early payment. Sole proprietorships, partnerships and S. corporations. A new 20% deduction for pass-through business income will be limited based on income, type of industry, wages paid and cost of depreciable property. Some of these businesses will have an incentive to reorganize to take advantage of the new rules. Parents who send their children to private school under law, tax-exempt 529 college savings plans can be used to pay for private school tuition. Families that send or plan to send their children to a private school can start benefiting immediately by contributing to a 529 plan. People who can defer or accelerate their income. The law reduces marginal income tax rates for 2018, so some people may be better off deferring income, for example, by delaying selling a stock or contributing more to certain retirement plans. But those in high-tax states may want to try to earn more this year, by selling a stock or converting a 401k or traditional IRA into a Roth IRA. The more a person owes in state income taxes before 2018, the more they can deduct before the limit kicks in. Most of the provisions in the legislation would take effect on January 1, 2018. The IRS said it planned to release new withholding tables in January, so taxpayers can expect to see changes in their paychecks as soon as February. There are only a handful of provisions in the legislation that apply retroactively, so just a small number of taxpayers will do some things differently when they file their 2017 taxes next April. Taxpayers with high out-of-pocket medical expenses. The medical expenses deduction will be expanded for tax years 2017 and 2018, allowing deductions for expenses that exceed 7.5% of income, up from 10%. Some will be able to deduct more from their 2017 taxes in April, and some will newly qualify for the deduction. Businesses that recently purchased equipment. A new provision allowing for immediate expensing as opposed to gradual deductions over time of capital Investments will apply to purchases after September 27, 2017, so some companies will benefit on their 2017 tax returns. Full expensing is allowed for 5 years before being phased out. Some parts of the plan are delayed by a year, so taxpayers will not be affected until 2019. People who do not have qualifying health insurance. The repeal of the Affordable Care Act's mandate that everyone have health insurance or pay a tax penalty goes into effect after December 31, 2018. Those who do not have insurance before that time will still owe the penalty. Alimony payments will no longer be tax-deductible for people who enter into divorce agreements after December 31, 2018. Because a vast majority of the legislation goes into effect in January 2018, taxpayers will see most of the differences when they file their 2018 taxes by April 2019. Nearly all of the tax cuts for households expire after 2025, while the tax cuts for corporations are permanent. The overall tax cut for households reduces income tax rates and brackets, repeals the personal exemption in favor of a higher standard deduction and a higher child tax credit, and sets new limits on itemized deductions, among other changes. These changes expire after 2025. The bill permanently switches to an alternate measure of inflation that many economists say is more accurate but will result in higher taxes over time. Lower-income taxpayers will be affected the most by this change if the individual tax cuts are not extended. Changes include a cut in the top corporate income tax rate, the repeal of the corporate alternative minimum tax, a scaled-back deduction for business interest, and a new territorial tax system for multinational businesses. These changes are permanent. The bill increases the minimum size of a state affected by the tax to $11.2 million from $5.6 million. This change expires after 2025. Sources: Tax Foundation, Tax Policy Center, PricewaterhouseCoopers.